We all know that stock picking is more of an art rather than a science. Anyway, there are some simple concepts that we need to master in order to excel on the stock market. This is why today we would like to talk about the heart of a business financial snapshot, the balance sheet, how to read it, and most importantly, how to use the information hidden in this document in order to value our investments. And now subscribe to the channel and let's start. What exactly is the balance sheet? Think of it as a photograph capturing a single moment in the life of a business. It tells us what a company owns and what the company owes at a specific point in time. This magical document is split into three main sections. Number 1, assets. Number 2, liabilities. And number 3, shareholders fund. First up, assets. Just to make it simple, assets are those things that the company owns, like cash, inventories, buildings, equipments, but also financial securities. Long story short, the scope of the asset is to generate more money for the company. They are the engine that leads to earning generation. Assets can be split into two categories: current and non-current assets. Current assets are those assets that can be turned into cash within 1 year, while to convert non-current assets into cash it takes more than 1 year. Simple. In the first category we can have items such as cash equivalents or tradable securities. While in the second category of non-current assets we can have long-term investments like properties, plants and equipments that last of course more than 1 year. Until this point everything is very simple. Next, liabilities. These are items that the company owes to others, or in other terms are their financial obligations. Just to speak basic, liabilities are those items that detract money from the company's pocket. Assets bring money in, liabilities take money out. Just like assets, liabilities are divided into two categories: current and non-current liabilities. Within the current liabilities, it is of foremost importance the items called short-term debt. That is the amount of money that the company needs to pay within 1 year. While for the long-term liabilities, we can mention long-term bonds that the company needs to issue in order to finance its business operation and the purchasing of the assets, but also mortgages and other kind of long-term obligations. Now, here is where things get really interesting. Third in the list, Shareholders Fund, that represents the money invested by the shareholders, and you can be one of them, plus the accumulated profits that the company kept over time, the so-called undistributed profits. It is essentially what is left for the shareholders after all debts are paid off, making the shareholders by definition residual claimants. And for the record, shareholders fund are accounted in the liability side of the balance sheet, because in a sense they are claims on the company's assets. Plus, it's a plug item that needs to balance the balance sheet. This is why it is called balance sheet. But this to say what? The balance sheet follows a fundamental equation: assets equal liabilities plus shareholders fund. This ensures that everything the company owns is funded either by borrowing money or through investments from the shareholders. It all balances out. It is worth noting that in order to provide more information to the shareholders, each and every item provides a more detailed breakdown about the maturities, just to keep track of what is going on between 1 year and another. Because if you have to pay something under time constraints, better to pay attention and play cautiously with your liquidity. And this applies to the company world as well. Until this point, everything looks pretty academic. And here comes the spicy part, because in order to use this information proficiently and to make money out of it, we have also to understand the numbers. And the way I prefer to understand the numbers whenever I have to value an investment is to put them in relation. And here they come extremely useful, the so-called fundamental ratios. We have already spoken about the price to book, that is given by dividing the price of a company by the book value per share of the same company. We have already told in other videos, link down below, that if this ratio exceeds 1, it could mean that the company is a bit overpriced. On the other hand, if it stands below 1, the company can be undervalued or underpriced. In investment banking, whenever a company trades below 1, we say that the company trades at discount compared to the book value. That is another name to call the shareholders fund. Another very important ratio that we can use is the current ratio, that divides the current assets by the current liabilities. In this sense, we can have a snapshot about the ability of a company to repay short-term obligations. That is a liquidity metric that allows us to understand whether a company is able to pay back short-term debt in a timely manner. And this caveat is assured whenever the company has a ratio above 1 or 100%. A third ratio that I would look at is the so-called debt-to-equity ratio, that divides the total liabilities by the shareholders' equity of a company, giving us a clear idea about how much leverage is a specific enterprise. Just to simplify, we can say that the higher the ratio, the higher the leverage, and the higher the riskiness of the business. On top of understanding the numbers from the single company anyway, whenever we talk about fundamental ratio, it's always recommendable to have a look also to the closest peers. In this sense, we can have a better dimension and a better understanding about the competitive environment the company has to face. So guys, there you have it, the balance sheet in a nutshell. A powerful tool to understand the financial health of a business at a glance. If you found this breakdown and these three ratios helpful, don't forget to give a thumb up, hit that subscribe button, and leave your questions in the comments down below. Thanks for watching and stay tuned for more financial insights. Of course, here on Beyond Alpha. See you in the next one. Cheers.
I think people, they're investing in individual stocks. It's sad they're careful when they buy a refrigerator or an airplane flight. They're careful with their money, and they'll hear about a stock on the bus, and they'll put $5,000 or $10,000 on it. They have no idea what they do. So you're really got to be careful. Look at the company, look at the balance sheet. What is the reason the stock should be higher? The sucker's going up is not a good reason.